Hi everyone, moving on to chapter 4. This chapter is about actually building the financial statements. All right, so just to remind you where we are in the overall process, we have the accounting cycle, right? And we start off with transaction documents, right? That's when we buy and sell things, right? Bills get sent in the mail, money gets received, right? There's usually some sort of documentation that gets recorded. That's what we do all month long as we're running our business. As we're receiving these documents, we are preparing journal entries from them. All right, so that's really kind of your chapter 2 stuff. After we record the journal entries, we update the ledgers, right? Because we update the totals of all the accounts that were affected during the month. And then we prepare a trial balance. Now, one thing about the trial balance, just to remind you, the trial balance really doesn't catch if you made any mistakes, like let's say I debited cash and I should have debited accounts receivable. All a trial, right, I mean, that's not going to catch that in a trial balance. The only thing a trial balance is going to catch for you is if you made a silly mistake, like you debited something for $20 and you credited it for $200. Then your trial balance is not going to balance, right? Or if you debited and you forgot to credit. That's going to be where you debited twice and had no credit, right? That's the kind of thing a trial balance is going to catch. So it'll catch like the most basic of errors. From there, we did our adjusting entries, right? That's chapter 3. Those are the things that the accounts that need to be adjusted, primarily because time has passed, or they're just entries that need to be done at the end of every month, right? The prepaids and the deferrals, if you remember that chapter, the deferrals and the accruals and so on. After the adjusting entries, we do yet another, well, we post to ledgers, we update our accounts again. I'm skipping parts here. We post to ledgers again because we want to update the balances with our adjustments. Then we prepare an adjusted trial balance. Okay, so it's the same kind of idea as just to make sure we didn't make any silly mistakes during the adjustment process. From there, we take our adjusted trial balance. This is where we're picking up with chapter 4, and we are going to build those financial statements. Okay, really all the thought process happens in the preparing of the journal entries and the adjusting entries. The financial statements part of it, there's not really a lot of thought that goes into that. Really, we're just going to pull the numbers off the trial balance and put them in the right places in the financial statements, and we'll have financial statements to look at. All right, after the financial statements are done, we put them out there to the world for everybody to review. Then we close our books. Okay, and that's going to be a new part of the process. And after we close our books, right, and you've probably heard that process before, right? When the people say they close books at month end or they close books at year end, the idea is that's what we're going to be doing. We're going to be closing our books. And we're getting ready for the next year. We start off the cycle again with new transaction documents and so on. Okay, so that's the whole accounting cycle and where we stand in it. So let's look at those financial statements again. We did touch upon them briefly in chapter 1 maybe. But here's the 3 that we're going to be focusing on. The income statement. The only thing that's going on the income statement is going to be revenues and expenses, at least for our purposes now. We'll add a little bit to it as we get into a future chapter, but for now, revenues and expenses. That's what belongs in the income statement, because net income is how much we made during this time period, right? All of the revenues, everything we earned, minus all of the costs to earn it, all right? All of those expenses gives us net income. Hopefully net income, not net loss. All right, that is going to be the first thing that we prepare. Now the thing is we have to prepare them in this order. We have to because we need this net income number to come on down here to the retained earnings statement. Now, I have retained earnings statement in this slide, but it can also be referred to as the statement of stockholders' equity, the statement of shareholders' equity, same thing. All right, retained earnings statement, right? Remember what that is. It's earnings that we made, right? We're running our business, we're making money, and that we held on to. So if there's a beginning retained earnings balance, we start with that. If there isn't, it's a brand new business, then you start with 0. All right, that's the money you made in prior years. And what we do is we say, okay, this is where we started the year with this balance, and then we made this money, this net income during the course of this year, and then maybe we paid some dividends out to the owners. Now, dividends are completely optional, but if we do pay money out of our earnings to our shareholders, those are dividends, those are called dividends. All right, and then what we have is our ending retained earnings balance. So it's like, this is what we had this much money, then we made this much more money, but we paid some of that out. So our ending retained earnings balance is here. Okay, so we'll look at it with numbers in a bit. From there, right? So it's our second statement. From there, we prepare a balance sheet. And our balance sheet is where we list all of our permanent accounts, the things that aren't going away just because it's a new year, right? We list off all of the assets that we have, all of the liabilities we have, and what our final shareholders' equity is. Okay, so the thing is like I said, the reason we have to prepare them in this order is because that ending retained earnings balance comes on down here to shareholders' equity. Okay, so they have to be prepared in this order for the amounts to flow through. They build off of one another. What we have here is we have what's called a classified balance sheet, meaning it's separated into short-term and long-term. Short-term is assets that you're going to use or convert to cash within a year. Those are current assets or short-term assets. Anything beyond a year, long-term asset. Same thing goes with liabilities. If you're going to be paying or responsible for or doing work like unearned revenue, if you're expected to do it within a year, it's a current liability. If it's longer than a year, long-term liability. And then your shareholders' equity section, you have stock, right? When people put money into your business, right? If somebody, puts, let's say I started a business, I put $10,000 into it. That's where that money gets reflected in that common stock account, the $10,000, plus all the money that I earned doing my job, doing my business. All right, and this is where your assets equal liabilities plus stockholders' equity comes into play as well. Your assets must equal your liabilities plus your stockholders' equity. That's your balance sheet, right? It balances. Okay, so, oops, we just talked about that. Now, one thing I want to mention, I'll move myself out of the way here, is that these things can be reported on not only a calendar year, which you see most of your examples are calendar year, right? January 1st to December 31st. Not all businesses run on a calendar year. Some of them run on a fiscal year. And the idea of the fiscal year is it covers a 12-month period. It doesn't have to be January through December. It could be April 1st through March 31st. It can cover any 12-month period. Now, why might a business pick a fiscal year? Well, the idea is that you don't want to pick the busiest time of your year to be stopping everything and preparing financial statements. So what you traditionally want to do is if your business has a typical slow season, that's when you should do your financial statements, because it takes time. It takes quite a bit of time to get all of the data you need to produce these financial statements. So if that's the case, like something like if you had a toy store, right? You're busy in December. You're super busy. And in January, you're still super busy because people are returning stuff. That's the last point in time that you want to be worrying about financial statements. Like something like the Christmas tree shops, right? That is not something you want to deal with at that point. It might make sense for something like that to have like a June 30th year end. That's their fiscal year. So it's up to the business what their year end is they choose. They have to stick with it for the most part. I mean, they can change it, but it's a big deal to change it. So once it's kind of picked, it usually stays that way. All right. There are 4 financial statements, but we're really only covering 3 in financial accounting. The 4th one we pick up on in managerial accounting. It's a statement of cash flows. And it's a little bit complicated to prepare. That's not why we're not doing it. We do plenty of complicated things. We're doing it because really that ties into financial analysis. And both of those things you do at the very end of very beginning of managerial accounting. You kind of get those out of the way and then you move on to true managerial accounting. Okay. One last thing. There's something called the worksheet in this chapter. We're not covering it. So if you see stuff with the worksheet, you can just ignore it. Why? Because nobody actually uses the worksheet in practice, so I see no point in teaching it to you. The worksheet is just a tool to help you build financial statements more easily. I don't think it's terribly helpful, and I think it takes a lot of time. So we're not worrying about that. Okay, I think that's it. Ooh. Okay, so I think we're good there. All right, we're going to prepare income statement, statement of retained earnings, and balance sheet. I feel like there's something else I want to say about it, but I guess I'll think about it later. All right. So I said before it was a classified balance sheet, and I said current assets, right? Current assets are assets consumed or converted into cash within a year, right? They're short-term assets. Examples of that, cash, accounts receivable. You expect people to pay you within a year, right? That's accounts receivable. Supplies, you're going to use them within a year. Any sort of prepaids. Really, even if a prepaid winds up being 2 years, a lot of times it just, falls into the current asset category because you are expected to use that up within a reasonably short period of time. Inventory. You certainly want your inventory to turn over within a year, right? Current liability, same thing, expected to come due within a year. Typical accounts payable, salaries payable, unearned revenue, right? All of these, your people expect to be paid within a year. If it's unearned revenue, it's when you collect cash and then you have to perform a service. They probably expect that service to be performed within a year. Okay, so those are your typical short-term and long-term short-term liabilities and short-term assets. One of the things we can do when we break it out this way, and one of the reasons why we do break it out this way, is we do something called the current ratio. The current ratio is just one of the very quick ratios to determine how well a business is doing. I mean, there's a number of financial analysis ratios. And like I said, you'll cover those primarily in managerial. But one of the easy ones that I want to point out here is the current ratio. All right, so the current ratio is a measure of current liquidity. Basically, can you pay your bills? Can this business pay its bills? So what we do is we take current assets to current liabilities. So we take all of our current assets to all of our current liabilities. And the idea is that we want to have more current assets to be paying our bills than we do current liabilities, right? If you think about it, this is all the assets that are going to be cash within a year, basically, or we're going to use them up. And we want to have more of those than we do current liabilities. Let's say you only, put really simple numbers on it. Well, let's say you only had $500 of current assets, but you had, $2,000 of current liabilities. Well, you have a problem because you can't pay your bills, right? You've got way less current assets than current liabilities. So that's the idea with the current ratio. It's just a quick liquidity measure. All right, oops. So you want that number to be greater than 1. You want to have more assets, current assets, to less liabilities. Okay. All right, so we'll pick this up on the next round.